Hello ladies and gentlemen, welcome to the review of the markets for October. My name is Chris Land, I'm the Deputy Chief Investment Officer here at True Potential, and today I'm going to have a look at how markets have performed and discuss some key themes that we're currently seeing. Okay, so starting off with equity markets in local currency terms, they have in general delivered fairly positive returns for investors in September, continuing the strong performance that we've seen this year. Global equities are up just over 2%, supported by healthy returns from developed markets excluding UK equities. US, European and Japanese stocks returned 2%, 4% and just over 4% respectively. Japanese equities have performed well, with the Japanese yen weakening over the month, nearly 6% against sterling. So that's really benefited domestic exporting companies and over the longer term a more investor-friendly Japanese government through improved corporate governance and dividend payouts. European equity markets produced favourable returns, helped by improvements in economic performance across the euro area, and the benefit also from a weakening euro. The impact from currency has been a significant influence on investor returns this month, with the yen and the euro both depreciating over the month. The euro began to unwind after what started off as a knee-jerk reaction after the German election, although this appears to have become a broader hit on euro bulls conviction. Sterling, on the other hand, has transitioned in the opposite direction, gaining nearly 4% against the US dollar. We have to remember sterling has fallen to very low levels following the European Union referendum in the summer of last year. Signs of stronger than expected retail sales figures and also the possibility of higher interest rates that could take place as early as potentially November this year has been behind the rebound in sterling this month. The impact from currency will depend upon the asset you hold. An unhedged, sterling-based UK investor holding overseas assets will lose out from sterling appreciating, however they will gain from sterling strengthening. On the other hand, fully hedging a portfolio helps to smooth the effects of currency movements. The broad mix of strategies within the True Potential portfolios provides a real measure of protection. The potential for higher interest rates in the UK has led to bond yields pushing higher, meaning returns from UK gilts and UK corporate bonds produced slightly negative results for investors in September. It's not just in the UK, where central banks are indicating the possibility of higher interest rates. In the US, the Federal Reserve continued to forecast one rate hike for this year, despite inflation being fairly subdued, and also announcing in October as when they would initiate the process of shrinking their $4.5 trillion US dollar balance sheet. Consequently, this is putting pressure on bond yields. In commodity markets, we've seen a resurgence of the oil price, reaching a 2-year high on the back of greater demand from China and Turkey's threat to disrupt oil flows from Iraq. This is in addition to OPEC, Russia and several other producers having cut production since the start of 2017. Okay, that's everything from me this time. I'll speak to you next month. Thank you.
Welcome to October's review of the True Potential portfolios. My name is Barney Hawkins. I'm the Investment Director here at True Potential, and I'm going to spend the next few minutes talking about our flagship investment product, the True Potential portfolio range. We'll start by discussing the performance of the portfolios. We'll then look at the key themes being pursued by our fund manager partners, and finally cover the changes that have been made over the month. During September, the portfolios fell slightly, giving back some of the strong returns already accumulated this year. A significant influence for market returns has been the impact of the strong currency. When returns from overseas assets are translated back into sterling, they face a headwind if the value of the pound has increased. Looking under the bonnet at how the underlying funds have performed, we've seen negative returns from the True Potential SEI range. In the defensive and cautious portfolios, SEI has exposure to a strategy called Global Managed Volatility. This strategy targets high-quality companies that exhibit low volatility and pay above-average dividends. However, it can be susceptible to fears of higher interest rates, and with Mark Carney, Governor of the Bank of England, giving his clearest indication yet that monetary policy is likely to be tightened, it would appear that, at least in the short term, some investors have been taking profits. On a brighter note, there have been good returns from the True Potential Goldman Sachs Income Builder Fund. Our fund is fully hedged into sterling, which has helped mitigate the effects of a rising pound. The True Potential Schroeder Fund has also performed well relative to our other managers, their high cash balance and an underweight bond holding helping to protect capital. In general, our managers continue to be reasonably constructive with regard to market conditions. Those managers who invest in direct equities, say Threadneedle, Close Brothers and Goldman Sachs, remain fairly sanguine about markets and are still able to find attractive opportunities despite valuations generally being high. In terms of trading over the month, there were several changes made within the portfolios. We continued with the theme of favouring stock pickers and those who manage their sterling exposure to help mitigate negative currency moves. As we progress through the market cycle and with most asset prices having risen, stock selection becomes an increasingly important way of identifying opportunities. So in the defensive, cautious, balanced and growth portfolios, allocations have been increased to Close Brothers, 7IM and Goldman Sachs at the expense of SEI and Allianz. In the lower risk portfolios, 7IM offers a more defensive tilt should bond yields nudge up and sterling appreciate, while the Goldman Sachs Dynamic Fund incorporates a variety of alternative strategies, helping the portfolios diversify away from interest rate sensitive bonds and equities. Turning to the plus portfolios, the changes which have taken place reflect a requirement to trim back on risk. Weightings to Close Brothers Balanced and Schroders Cautious have been increased as they are lower risk compared to 7IM Aggressive and SEI Aggressive, which have been reduced. Allocations across the income portfolios remain unchanged.